Are we live? We're ready to go?
We're live. Let's do it.
All right. Happy Tuesday, September 24th, October. Man, I'm like a whole month ahead. Welcome to the investment committee for the September series. We're excited to bring to you, yet another episode of our view on the market. Sean, do you want to pull up the PowerPoint so we can kind of go through it?
Sounds good. Pulling it up right now.
All right, today we're going to have a special guest with us to go over the Corporate Transparency Act, which is going to be super interesting for anybody who has their own business or any other entity that they report to the IRS. So trusts that have their own EIN, any sort of company that you have, whether it's a holding company or actually has an active business. The Corporate Transparency Act is something that has just been really let's call it enforced for this year. And Marty's going to be talking a little bit about that at the end of the update. For now, I'm going to have Sean jump into our market update where we see the market for the month and kick it away, baby.
Sounds good. Thank you, Bobby. S&P so far this year up a little over 20%. So in the last month, it was up 1.8%. It just continues to chug along. When we look at it compared to some other major indices, the NASDAQ 100, the S&P is actually outperforming the NASDAQ, which is a bit technology heavy, by about 1.5%. When we look at it compared to the Dow Jones, which is a lot of blue chip stocks, the S&P has outperformed the Dow Jones by over 8%. The Russell 2000, which is a lot of small cap companies, has done 10% worse than the S&P 500. And if you look at the international stock index, the S&P has also outperformed that by about 10%. So it's really interesting to compare the performance of the S&P 500 to some of these other major indices that track the markets. And just seeing the gap that is in between the S&P and some of these other indices is fascinating.
Well, it's been kind of the same story for the entirety of the year. Being in an election year, this is typically a hot market to expect, to anticipate. We try to say you never invest with your politics. It's usually just an election year in general.
Yeah.
But it's also a good indication in the sector performance to show that while the S&P 500 is outperforming, there are some clear leaders, pushing that index forward.
Yeah, I mean, I think the big news this month was the Fed rate cut that we saw last week. The Federal Reserve cut by 50 basis points or 0.5%. And a lot of the numbers that we're seeing on this page in the last month have to do with that rate cut that we saw. So we see the 10-year Treasury rate over the last month came down a little bit. That's a result of that rate cut that we saw. The US dollar is losing some value over the last month. And that's because foreign investment is not as appealing in the US when interest rates are coming down. You look at something like US Treasuries, which have been such a good investment. They've never defaulted. You're able to get 5% out of US Treasuries a month ago. Now we're starting to see that rate come in. Some of that foreign investment may be leaving. So that's part of why we're seeing the strength of the US dollar come in a little bit. But like Bobby said, when we look at some of these sectors, it's interesting to see what comes out on top versus on bottom over the last month, especially when you're looking at some of these sectors that maybe are a little bit more interest rate sensitive. Brandon, what are you seeing in terms of some of the sectors that we've been looking at?
Yeah, I think it's something really interesting. And, a lot of people have been talking about, throughout the year, whether technology is still leading the way, what's the rest of the market going to do? And you're kind of seeing now, what's everything doing year to date, as well as that 1 month. So like utilities, for example, up 28% year to date, but then also being up, 7% in the last month. Where, some things that were clear winners earlier in the year, like the, semiconductor ETF stocks, is only up about 16.7%, and is down around 3% over the last month. While still like long term, good investment, I think you are experiencing some short-term volatility while, others are really, continuing to go up and show that positivity.
Yeah. What also is interesting, because we have a lot of people who are following real estate markets, following mortgage rates. Everybody's anticipating mortgage rates to come down. And it's really this 10-year Treasury note that indicates, where mortgage rates are going to be headed, because they're typically pegged against this number here, as opposed to the Fed overnight rate. So I think that people anticipate, mortgage rates to all of a sudden plummet down to zero That's another thing to kind of keep in mind as this treasury rate goes down, is how they're going to correlate with mortgages, hopefully.
Yeah, there's definitely a lagging effect to the interest rates coming down when it applies to things like mortgages. Yeah, let's take you guys on to some of the news stories that we've been seeing. The first one, we already started to talk about it, but that Federal Reserve rate cut, 50 basis points in the September meeting. As we look forward to the November meeting for the Federal Reserve, the expectation is that these rates are going to continue to come down. So right now, the market is pricing in a 56% chance of another 50 basis point cut in November, and a 44% chance of another 25 basis point cut. So the consensus is that rates are going to continue to get cut as we look forward to that November meeting, and on past that, a year or two into the future. These rates are directionally going to be coming down, dependent on the data that the Federal Reserve is seeing. But you guys are probably wondering, how does this affect you exactly? The first place, money market fund rates, certificate of deposit rates. These have been really popular investments for investors over the last 2 years because you're able to get 4 or 5% returns in very safe investments like these money markets and CDs. So those rates are going to start coming down along with that Federal Reserve rate. As Bobby was saying, there's a lower cost of borrowing now for consumers and businesses. So on the consumer side, things like mortgages, auto loans, those rates are going to start to come in a little bit. And then on the business side, for small businesses that are looking to maybe fund new projects, those begin to look a little bit cheaper for those businesses, which will stimulate the economy a bit more. So that's the goal of the Federal Reserve by bringing in those rates, is to stimulate the economy a bit now that we've seen inflation come down to a level of 2.5% year over year. And we're just going to continue to see and monitor how this affects consumers and businesses over time.
Yeah, I mean, I think the worst thing that they want to do is be behind the curve, and they're already a little bit behind the curve. So staying ahead of it is important.
Yeah. I think that's been one of the largest criticisms of the Fed, is they're always 3 steps behind. So they're trying to get ahead of this one, but it's a hard game to play when you're in their shoes, I think. It's a fine balance.
Especially since it's frontline news, and we're in an election year, so this all becomes things that were dealt with more behind, let's say, more closed doors in the past have really come to the front lines. And I think that makes it especially a little bit more nuanced.
Yeah. I think that brings us.
Sean, might be helpful just to talk a little bit about, inflation numbers and how they've come down versus the fact that people are still paying kind of high prices. How does the average person who doesn't kind of study all this stuff make sense of all that?
Yeah, that's a great question. So inflation was at 9.1% in June of 2022. It's now down to a rate of 2.5% year over year. So that Federal Reserve long-term target of 2% is very nearby. We're close to it. But like you said, Jordan, people can't expect prices to actually come down. Prices are still inflating at a rate of 2.5% per year. So even though that inflation rate has come down from 9%, prices are still going to increase, just at a lower rate. So we're not in a deflationary environment where the prices of eggs are going to start coming down wildly. But we are at a healthier inflation rate as opposed to where we were in 2022 when we were seeing those big numbers of 7, 8, 9% year over year inflation. We're now way closer to that target rate of 2% that the Federal Reserve has for inflation in the long term. Is that helpful?
Yeah, I think that's helpful. And then, another thing that people kind of, one of the things I think is interesting is how people talk about the economy is doing better, but not doing better for everyone. And that's something also to keep in mind, that where inflation doesn't get felt across all items, but inflation is generally up. Wages and income are generally up, but that doesn't mean it's necessarily going to be up for every single person. It's just kind of an aggregate. And I think when we talk about the economy, we talk about the aggregate change, and then people have to think about, well, what's their personal change? And that's not always going to be lined up, and it's not always going to happen at the same time as it happens for the rest of the economy. And just always something to keep in perspective.
Yep. I mean, we saw gas prices yesterday, $2.99 at the gas station for a gallon. That's lower than we've seen in a long time. So gas is a little bit of a different story because it's a commodity that will see the ups and downs, and you will see some decreases in that.
Well, that also has to do with seasonality. It also is supply and demand. Said it's more of a traded commodity as opposed to eggs and bread at the market. But to Jordan's point, labor's also been inflated. So the fact that we're normalizing, from an inflation standpoint on costs of goods sold, that should create just like I said, a new sense of normalcy for people. And to your point before, it's still increasing at a 2.5% rate, which is a lot more manageable than 9%.
Definitely. I think that brings us right in.
Everything's relative. It's all perspective.
Yeah. Brings us right into our next news story. Money is flowing out of money market funds. So we've kind of touched on this a little bit so far, but money market funds, we're seeing rates of 5.25%. As these Fed rate cuts come in, that's going to become a little bit less appealing over time. So where are these funds going to be going? Money market funds have been probably a favorite for investors over the last year, just because you're able to get that safe 5%. So funds have actually been flowing into a little bit more speculative investments. As we look at dividend stock funds, they had their largest inflow in the last 24 weeks. Cryptocurrency had their largest inflow in the last 8 weeks. Equity funds, same thing, largest inflow over the last 8 weeks. So you're seeing money flow from the safe money market fund into some of these other more speculative investments, while dividend stocks can kind of replace some of that income generation. They're not as speculative. You look at cryptocurrency and just equity funds in general, that's definitely a step up in the curve of volatility and risk, I guess, when you compare it to something like a money market fund. So it'll be interesting to monitor over time as these rates come down. Where are all these funds that are currently in money markets going to end up going? Are they going to be put into the equity market, other fixed income funds? It'll be interesting to see kind of how that plays out over time as the Fed likely continues to cut that rate down. Anything
for people who are sitting in cash who aren't making money market type of returns, or they're starting to see their percentages go down, what is it that you're going to do with that excess cash? And that's more of a conversation now than it was 2, 3, 6 months ago. So starting to really manage the liquidity and the excess liquidity or the excess cash that you have on hand is becoming another planning conversation, because it was always a planning conversation when interest rates were zero. It kind of went away because it became a place to just store, later deploy in the future when opportunities arose. And looks like interest rates coming down, people are looking for those opportunities now. So, what are the opportunities that you are looking at as individual investors is going to be a really important conversation, because just like the Fed doesn't want to stay behind the curve. You don't want to stay behind the curve either. You want to start to really think about how you're going to deploy that cash.
Yeah. And this isn't something that's changing overnight. The money market fund is still yielding about 4.9%. So this is something to monitor over the next couple of years as we're seeing those interest rates come down. The money market is still a pretty appealing place to be for a lot of investors, offering that close to 5% now, with no volatility. So something to continue to monitor.
I think Bobby made a really good point there, which is this was not, this cut that they had was pretty communicated. We saw this one coming. There was arguments it was going to be 25 or 50, but I think we knew they were going into a rate cutting cycle, and we knew that a couple months back, and they're likely to continue that rate cutting cycle, as you said earlier, Sean. They're expected to make some additional cuts this year, and those cuts may even continue into 2025. So, in some ways, if you're kind of waiting to have the conversation as those cuts happen, you're going to be behind the curve the same way as Bobby mentioned. The Fed's been a bit behind the curve. And it's worth just kind of figuring out that strategy ahead of time versus waiting for, things to happen. We kind of know directionally which way things are going to go. We don't know exactly how it's going to play out, but kind of figuring out where to go and when to go there. It's better to have a plan in your pocket than to just kind of react as things start to change.
Well, it's eerily reminiscent of going back 8 years ago, and not reminiscent in the fact of interest rates and the movement of interest rates, but coming into an election year with the anticipation of not knowing who's going to get into office and people sidelining a lot of cash. And it just so happened that, the market was betting on Hillary Clinton to win the election, and people thought if Hillary took it, the market would continue to go, but if Trump took it, we would be in a bad situation. And Trump ended up taking the win and coming into office, and the market continued its upward ascent. Now, people who were sitting with cash on the sideline that didn't have a plan on how to reincorporate or redeploy that, they were just sitting and waiting and waiting and waiting, and they have lost the past 8 years, the ebbs and flows, the opportunities to get in at a reasonable rate. And if you start to plan on how you're going to re-enter into the market, it's usually not the flick of a switch. It's not like, oh my God, it's time to get in, and we just deploy everything. It's usually a planning strategy of how do we get in a smart and thoughtful way. So with that being said, let's take the emotion out of investing and start to talk a little bit about red and blue. Donkeys and elephants.
That was great. But this is, something I've been seeing a lot of different examples of this, of you invest, $1,000 or $10,000 only during certain presidencies, Republic or Democratic, versus, just keeping invested the whole entire time. And it's really going to, Bobby's point about, one, using cash on the side and coming up with a thoughtful strategy of getting into the market. And then two, really just having that long-term investment mindset. You can see, just on the graph to the right, if you're only invested with a Republican president, it's around 83,000. If you start out with $10,000, and similarly for a Democrat, it's about 254. But if you're just staying, invested throughout this time period, which is 1953 to now, it comes out to $2.1 million. And it's really about that. Yeah, there's ebbs and flows, during every presidency, but it's really about, what's driving the market, some of the fundamentals like, valuations in companies, their earnings, watching those driving factors and really taking advantage of the opportunities as they, come along. And then having that long-term mindset and not necessarily, worrying about things outside of your control and, getting out of the market during short-term volatility spouts. That long-term investment really proves to be, a great factor.
That's crazy too, because you have so many people who are just so focused on their own political mindset, where they believe their party to be from an economic standpoint. And when you start playing that picking game, and some people like to call it timing the market, look at how impactful it is to really time the market around your politics. I mean, that's a dramatic and substantial difference of just staying invested regardless of politics versus picking a color, blue or red.
Yeah.
Yeah. And you're seeing the spouts, some go up right away, and then in other years you're kind of seeing that decline in the first couple of years of the new president. So it's kind of just, waiting out those factors. Yes, sometimes there might be a short, volatility. Sometimes it might be later in the presidency. It's not necessarily them driving that. It's, really comes down to the market and some other, outside factors. So really staying invested and thinking logically, really pays off at the end. So here's another chart showing the S&P 500, returns from 1993 to 2023. You can see the left column shows, the number of years, and then that top row shows, the calendar year start. So there's some good takeaways I thought, just to highlight quickly. You can see the annualized return since 1993 is 10%. There's only 5 time frames that resulted in a negative annualized return, which is 1999 to 2000, 2004, and then 2007. And those returns range from about -2% to 29%. And then there's only 2 time frames that result in negative annualized returns after 10 years. And those returns range from -1% to 17%. Obviously, there's a lot more green on this page than red. And, going back to that last page, I think that kind of plays into the same long-term investment mindset. And then also, another key thing that I think is important to highlight is if you go to, 15 years and then 20 years and 25 years, you start to see those annualized returns come closer together, start to be around that 7, 8, 9, 10% over the long term versus where you might be dealing with a little more volatility, throughout the beginning years. You can see just, if you're looking at 1 year, it's going from negative 22% in some years, but then 29% up in some years. And then as you start to go, further and further down this chart, you can kind of start to see them all coinciding together. And that's really, similar to the last page. Markets are going to go up more than just looking at historically from this chart. And it's really playing to that advantage. What opportunities can you take advantage of? Maybe there is some volatility or a downturn that you can. Maybe there are a string of good years, but how can you really recognize that and kind of take advantage of opportunities? And,
Well, I think if you think of investing as an experience, right? What's the kind of experience that you want? Do you want something that's going to be a little bit more flatlined and you're going to average out this 7%, 6%? Do you want something with a little bit more volatility? And do you want to try to get a little bit more juice to your portfolio based on your need of when you actually need to take the money out and use it for your life? And I think what a lot of people's experiences or behaviors are, they get into situations like these red moments in time, and they go, I knew it. Every time I put money in the stock market, I lose. What I see, this is why that you can't invest in the stock market, because you put the money in and you lose. And the reality is yeah, I mean, there's some short-term volatility. And if your behavior is telling you losing money requires my stomach to get upset, which then, creates my stomach getting upset, then requires me to go and sell at a loss, you're going to hate the stock market. But if you start to look at those red opportunities of how do I take advantage? How do I buy things on sale? Then you'll start to up that range of return over that period of time. And this is more just a annualized, S&P. Has no consideration of, okay, when are we deploying assets? So similar to my conversation with you guys on the, redeploying your money market funds and what's the plan of reentry into the market. These are things in the, within your investment landscape that you should be taking into consideration, as time goes by and you're investing in markets.
Awesome. That's the conclusion of the market update for today. I think we have Marty with us now.
You're unmuted now.
Hello,
Marty, how are you, bud?
how you doing?
I'm good. Welcome to the investment committee webinar. We appreciate you spending the time. I just want to give a quick intro to all that are watching. Marty's a partner in over at Mandelbaum, and he has extensive experience and knowledge in this field and of trust estates and taxation, and is going to share with us some of the things that we should anticipate as business owners, or if we have any trusts, or if we he's going to go through the requirements of what you would need for the Corporate Transparency Act, which is a new thing that's really being enforced this year for people who have those types of entities. So Marty, really appreciate you joining us and spending the time and sharing some of the knowledge that you have around this topic.
All right, my pleasure. All right, basically the Financial Crimes Enforcement Network, FinCEN, issued final regulations last year, which became effective in January of 24, which requires that reporting companies report certain information to FinCEN. And basically the most important point of this is companies that were created before January 1, 2024 have until the end of December 31, 2025 to report. Companies created during calendar year 2024 are required to report by the end of this year, within 90 days of filing, for companies formed after January 1, 2025, excuse me. They have 30 days from the date of filing. And basically, filing is defined as anything that you file with the Secretary of State or Division of Commercial Reporting here in New Jersey. And what you have to disclose is the names of what's called beneficial owners, the names of the filing people, and names of and addresses of the entities. What the issue is that what constitutes a reporting company? There are 23 entities which basically are excluded. They're large companies, insurance companies, brokerage firms, things like that, that are already regulated. But this applies to every small business, with the exception of businesses that have over 5 million of revenue and over 20 employees. So if you have clients who have set up LLCs to own or manage real estate that they lease out, and it's just a mom and pop, they're subject to reporting. If you have investment companies or investment groups, 5 guys decide to set up a new business, that's a reporting entity. And basically, the reporting companies have to disclose what's called a beneficial owner. And a beneficial owner is basically defined as anyone who owns more than 25% of the entity or has control. And they also created a class of what's called a company applicant. So let me just give you a real life example. Friday, I set up an LLC for a client. The members of the LLC are 2 other LLCs. And in the operating agreement that we're drafting, a 3rd LLC is going to be the sole manager. So what happened was, when I filed that certificate of formation for the LLC, I became what's called the company applicant. So in this situation, the company applicant has to be disclosed when the company files its registration, and it also has to disclose the ownership information for everyone that has more than a 25% interest. So in this simple case, the 2 members of the LLC are reporting entities. I became a reporting entity because I was the company applicant, and the entity that's going to be the manager of the LLC is deemed a beneficial owner because he is going to have control. So the FinCEN said that people like myself who are a company applicant, I don't have to disclose all of my personal information to all of my clients. I can get a FinCEN identifier number. I guess it's going to be something similar to a social security number. So when this new LLC that we set up files, it's going to list the names of the beneficial owners and all of their information. The information they have to reveal is names, addresses, and you have to provide a bona fide document. It has to be a scannable driver's license, a non-expired passport, and all these things have to be uploaded to FinCEN. So now I have a FinCEN identifier number. So I just tell the client, my FinCEN identifier number is 12345. They fill out the registration forms, which say, this is the name of the company, this is the date it was formed. You have to attach a copy of your certificate of formation. You have to reveal your federal identification number, and you have to reveal the name of the company applicants. And for entities formed prior to January 1, 2025, you don't have to disclose the name of the company applicant. And now for company applicants, you only have to disclose a maximum of 2 people. And how that comes into play is, if I physically file the certificate, I'm the company applicant. If I tell my assistant to file it, she's the filer, but she's filing under my direction. So both of our FinCEN numbers have to be revealed to the filer.
So this sounds like it's a lot of work for people who have to manage a lot of entities. Do you see that there are professionals that are helping them and guiding them through? Is that something that you help, or is this something that you're just educating on?
Basically, we are not doing the filing. There are filing services that for a couple $100 fee will do it. But again, most accountants and most law firms are not going to do it. And here's the reason why. You have to, if there is a change, let's go back to my simple example of the LLC I set up on Friday, and they hired an LLC as a manager. If that manager changes, you have to report within 30 days. If you are a member, let's say you and I set up an LLC, and you and I are the two members, and you're licensed, you're living here in New Jersey, I'm living here in New Jersey, and we've registered and everything's fine. You decide you want to go down to Florida, sit on the beach and drink pina coladas. You've now changed your address. You have to file. You have to file within 30 days of the change of address. So basically, this becomes onerous for people that have changes of managers. And it's not only a manager, it affects anybody who has control. For instance, if you have a business and you have a president who may not be an owner, but is in control of the day-to-day operations, he becomes a reportable person. So now you have to disclose his information, name, address, social security number, and you need a genuine document. If the president leaves in 6 months, you've got to refile. So basically, because we don't want to be responsible for having to do all of the refilings every time somebody leaves or there's a change in ownership or a change in address, we're not doing it.
What do you think the learning curve is on something like this? I mean, how long do you think until people get it right? And are we looking at heavy and hefty penalties and fines for those who have to muddle through it and don't really quite get it right on the first pass?
Well, yeah, there are civil and criminal penalties. The civil penalties are up to $500 per day until it's corrected. The criminal penalties are up to $10,000 and 2 years in prison.
Which is no slap on the wrist.
No. And the problem is, they have been putting this information out, but I was meeting with a client last week. He has 4 different LLCs for his real estate ventures. And I mentioned to him, I said, have you filed your beneficial ownership information? He goes, what are you talking about? He said, never heard of it. Now, I know our firm has been putting out monthly blasts to our clients about this reporting requirement. It's been the subject of news reports, newspaper articles, seminars. But there are people who claim they don't know. And basically, just to give you an example, as of July 29th, there were 2.7 million companies filed. And the government estimated there would be about 36 million companies that are subject to FinCEN requirements. So you can see there's a very small percentage of people or entities who have complied.
So this could potentially be a problem for a lot of people, especially if their head is in the sand right now and they haven't heard of it, they're not exposed to it, they don't know what the hell's going on. This is something that is going to be a wake-up call for a lot of people after this year. It sounds
right.
like.
Again, the question is this: if you have direct control of your client's accounts, does that make you a responsible person? You take a trustee. The biggest thing now that September 10th, 2024, they issued a 55-page beneficial ownership frequently asked questions update. So this stuff is still being updated. I mean, it's crazy. a lot of his new stuff is coming out about trust and trustees. If you're a trustee of a trust that controls an LLC that owns property or investments, you become a reportable person. If you have the ability to dispose of assets, you're a control person. And then in the examples they talk about in this new announcement, there's something called a trust protector, who sometimes we use to change trustees, change beneficiaries, things like that. But if that trust protector has any ability to change investments or change investment advisors or investments, he becomes a reportable person. Okay, and then the question becomes, how far down the line does it trickle? And there's a lot of stuff that's still unknown, untested. There has been a number of legal challenges to this. There's a leading case right now in the South where the court held that this trade association has a case pending in a court to suspend the application of CTA. The American Institute of Certified Public Accountants and all of the state societies have joined in an amicus brief in support of suspending or canceling this. And then the whole point of all of this reporting is to prevent money laundering, sham investments, and things like that. But now here's a scary thought. You're going to have a government agency that is going to have all of this information about you, your businesses, and everything involved. And that's supposedly only going to be released to bona fide government agencies with a bona fide need. Now, do you see any loopholes there? I mean, this is crazy.
Not only loopholes. I mean, just think about the exposure, especially in this, this environment of digital fraud that we're in, and the accessibility now of people being able to get and access information. That sounds a little not great.
How many times have you gotten these notices in the mail that your credit card or our credit history has been hacked? Now, can you imagine if this database is hacked? I mean, now we've got millions of people's names, addresses, dates of birth, social security numbers, and a copy of their driver's license or passport.
But to your point before, the penalties are severe if we don't comply. So at this point, this is one of those things where until we're told otherwise, we should be complying.
Well, we're telling our clients, you've got to comply. I mean, because again, what's the old line? I'm here from the government. I'm here to help you.
Sorry, maybe that didn't require such a chuckle, but you got me on that one.
It is what it is. But again, this information is pretty scary. Again, the issue we've got is, reporting companies. And again, it doesn't affect the General Motors of the world. It's the small mom and pop businesses. Again, the threshold is 5 million in sales, 20 employees. So think about how many businesses you deal with that fall under that threshold.
A lot.
And and it becomes a real issue. And especially when you throw in things like trusts. If you have a trust that owns a piece of real estate, or a trust that owns an investment portfolio, they become reporting entities. And anytime there's a change in ownership, I'll give you an example. If there's a trust and the minor is the beneficiary of the trust, you don't have to report the minor's information. You have to report the parent's information. But once the minor reaches age of majority, you now have to report the minor's information because he's no longer a minor. So again, it's a constant update. Every time there's a change in ownership, anybody who has control a child becomes emancipated. All of these things have to be dealt with. It's going to be a real nightmare. And this is why accountants and lawyers don't want to be involved with it. We've actually put in new language in our operating agreements that say that the members have an obligation to report any change in the information required to be filed with FinCEN. So if you move to Florida, you've got to notify us so we can file an amended report.
Yeah, the liability is just, it's off the charts, because especially for someone, you know, who's like, you know, like us professionals who are working with, you know, a large group of business owners, to take on that responsibility just doesn't, it just doesn't make sense. There's too many variables that can change without our knowing that would,
Exactly. And that's why the accountants and lawyers don't want the responsibility. You know, again, any of these small businesses where, you know, or an investment partnership, you get three guys who get together and say, let's buy a building. Okay, three guys, that's, each of them owns 25%. And if they bring in an outside manager to administer or run the building, he's a reportable person. If somebody in that three-member group changes their residence, if you move from Bergen County to Morris County, that's a change. You got to report it. You know, these are the kind of things that, you know, are driving people crazy.
I couldn't even imagine what the new expected revenue is from just all of this, you know, taking into consideration any lack of productivity or time
Well,
out of.
It's not a revenue generator for the government. There's no charge. You can go on the website and get a FinCEN number. I did it because I didn't want all of my clients to have my personal information when I'm an applicant. I have a FinCEN number. It took about 15 minutes. The
Yeah,
hardest
but for the
part,
people who didn't do that and they're going to get penalized, I mean, that's got to be a
Yeah.
lot of revenue that comes in if there's so many people that need to report and few have, and I don't know. This is interesting.
I mean, in my opinion, it becomes almost an unenforceable event. I mean, you've got millions of entities that have not or may not comply by the end of the year. How would they don't have the manpower to enforce it. I mean, you think about this, the IRS audits less than 2% of the tax returns filed. Okay, so how are they going to enforce? I'm not saying they're not going to. I'm just saying is they need a huge amount of manpower to address that issue.
Mhm.
Marty, is this something that FinCEN is continuing to update the requirements that are necessary from some of these businesses and trusts, or is this pretty set in stone? Because I feel like it's been a bit of a moving target since it was introduced a year or so ago.
They've come out with modifications to their FAQs. Like I said, the last one was September 10th, and there have been 4 of them this year already. You know, that these guys are on a roll. Because the problem is they put out a pronouncement and somebody calls up and says, well, what did you really mean by that? And they said, oh, yeah, we never thought about that. And it's the Wild West with these guys.
So what kind of advice do you have for business owners for who they can use as a resource? I know you said a lot of lawyers don't even really want to touch this.
Well, there are filing services that'll do it for a couple of $100. And we tell them to do it, use it. Or you can go online. I mean, if you're computer literate, it's not that hard. All you need is the basic information, and you have to be able to scan your driver's license or passport. I mean, I did it. It took about 15 minutes.
Yeah, that's not that bad. And if you have
But
multiple entities, multiply that by,
Not bad,
whatever
yeah.
entities you have, and hopefully there's some efficiency of.
Well, see, if you take an individual who, let's say, has 5 or 6 different LLCs that he owns, he can get a FinCEN identifier number, and then all he has to do is, when they ask for your identifying information, just type in your FinCEN and it populates.
Okay.
So, I mean, there is a way around it. I mean, it's not that difficult. You know, again, some people are computer adverse. But again, it's gonna have to be done. It's like in your business, you have your know your customer rules. You know,
Mhm.
again, it's the same kind of thing. You have to be able to document what's going on. And they want all new businesses starting next year to file within 30 days. You know, we had suggested that when you file a certificate of incorporation or a certificate of formation, that they automatically shuffle you off to a link that'll give you the FinCEN information you need. You know, but again, you know, nobody listened to suggestions from attorneys.
So Marty, let's say I'm a business owner, I go in, I get my FinCEN number, I go through the CTA, I report my entities. Until there's a change, like the changes that you had noted, until there's a change, I'm okay. I don't have to do this every year. But the minute there's a change,
There's no annual filing, and if there's no change, you don't have to file until there's a change.
perfect. We do have somebody who has their hand up. If you could just throw any questions that you have in a chat, that would be great, so that this way we can see it. Because we'd love to make sure that we answer all questions that you may have. What are some of the typical questions that you hear? Because I know that I've heard you speak on this before, and I know you've done this a multitude of times. What are some of the most commonly asked questions that you hear from people who are who are listening to you about this CTA?
The typical question is, why do I have to do it? It's a basic question. You know, you take a typical mom and pop who own a piece of commercial property and they put it into an LLC for liability purposes. Okay, you know, they're not drug smugglers, they're not laundering money, but again, now they have to report. They have to report all of their information about themselves, about the entity. You know, again, it just has to be done.
Okay.
And if mom and pop decide they want to start gifting for estate planning purposes, interest to their kids, now they've got a reporting situation. You have 30 days to report the changes. So it's something that has to be monitored on an ongoing basis.
Now, do you guys provide any sort of resources that if we were to just, redirect people your way? I mean, obviously you don't want to field, hundreds of phone calls ad hoc that are going to be non-clients because there's just not enough time in the day. But do you guys have resources on your website, or do you have any, any way that you redirect people other than going through the 57-page frequently asked questions? What resources do you guys have?
Basically, what we have some information on our website. I'm willing to take some calls. But the problem is they're going to have to go to the FinCEN website, register. Like I said, the hardest thing I had was uploading my driver's license.
Okay.
You just need your federal identification number, a copy of your certificate of formation or incorporation, and your name, address, social security number.
Now, can you do the upload? Did you do the upload with your phone? Did you have somebody scan it to your computer? What did you find to be successful for that?
I mean, I did it with my computer. We scanned my driver's license. We saved it to my C drive, and then we attached the file.
Okay. Well, listen, I know that there's a mountains of information and another mountain of questions that people have surrounding this. And, with this year being I guess the first real year that this is live for most people, you probably are fielding a lot of questions, and we really appreciate the time that you spent sending us over information. I would like to say that we have the, sorry, Sean, we have the presentation.
Yes, we do.
Marty, can we share that with clients that are looking?
Absolutely.
Okay. So we're going to put that on our website. The webinar is getting shared through our community. And we can be just as much of a resource as you need to help direct or answer questions, where we can bring, Marty and his team in where we think it might be applicable. We can make the, the proper introductions. You have the website that we'll put as well in the chat for Mandelbaum, and we'll put a direct link for people to take a look at that. But if we want to have clients that are signing up for your, your monthly commentary and distribution and news on all this stuff, they can do that right on the website.
Yes, yes. And then my email is in the materials we sent out. So, I mean, I'm happy to take any email questions. And if people want to have them added to our email lists, if they send me their contact information, our wonderful marketing department will be happy to add them to our mailing list.
Well, listen, I know this has been a lot. Oh, sorry. Oh, I guess that was my echo. I thought somebody was trying to talk over me. I know you've put a lot of time, energy, and effort into, getting your arms around this for clients and for, for education purposes for professionals like us. Really, like I said, I appreciate your time. I know that we're running at 5 o'clock on a Tuesday. And if there's any questions that anybody has, we'd love to help you navigate around as much as possible. Similar to what Marty said, we're not taking control of doing this for clients, but we're more than happy to act as a resource. And all of Marty's information, everything that he's provided for us today is going to be on the website. The webinar will be up. And if you have any desire to jump on their sign up for their newsletters, please do that, because as this thing starts to come into form, you're probably going to want more information than less, especially with hefty fines on the horizon if you don't do it correctly.
And if you gentlemen get any questions from your clients, you can send me an email and I'll try and help you with them.
Yeah, that would be fantastic, because there are already people who are asking, which is why we wanted you to come on today, just to throw out some blanket information and share some knowledge. So once we start getting into the end of the year, we ourselves are going to start to promote, and we'd love to tag your name on that and all the stuff that you shared with us as well. So anything else that you'd like to say before we part ways today, Marty?
No, I just encourage people to start filing before the end of the year, because the penalties in theory kick in next year.
Yeah, and depending on what your economic cycle is in your business, we are going into October. That means last quarter, October, November, and December is all you have left. Holidays come in December, so get this thing on the forefront of your priority list, because it's like the the book Eat the Frog, right? This is going to be something that you're going to push off, and you're going to push off, and you're going to push off. Just get it done and put it in the rearview mirror, and keep a notation that when changes happen within your organizations, you may have to refile. But we'll keep trickling information your way as months go on, years go on. We'll make sure that people kind of make this part of their annual checklist for not only our end of the year, but I'm sure that Mandelbaum is going to be provided with a lot of information, and Marty's got a lot of resources to share as well. So listen, that's a wrap on this month's investment committee. We appreciate everybody who showed up. We had a really, really good list of attendees on the webinar today. Appreciate you as a panelist, Marty, and we will get this out to the rest of our organization, and share, like, and disseminate to your people, because this is all good information, and we want to make sure that everybody doesn't get fined, doesn't end up in jail.
Thank you, gentlemen.
Thank you. Thanks, Mark.
Thank you, Marty.